And so these three golden rules, kind of like over my career, people have asked me literally hundreds of times, like, what should I buy? What's the best value? So I've kind of tried to boil it down. Now, they're only guidelines. They're not like hard rules that you absolutely have to follow. Just keep that in mind. But there are guidelines that, especially for newer investors, can get a good start with. So the first golden rule, like you said, is that gold has a lower premium above the spot price in percentage terms than silver or platinum or palladium. So basically what that means as an investor is that additional premium you're paying for these physical products is more cost effective for gold than the other metals on the table, the silver, the platinum, and palladium. So rule number one is, if you're looking at this investment strictly from a cost savings point of view, gold will be your best value in terms of a metal. And it happens to be kind of the cornerstone of most precious metal portfolios anyway. So you want to get that one out of the way early if you're going to be buying metal.
Okay, perfect. So number two, bars have lower premiums and total spreads than coins. So to me, that sounds like bigger might provide better value. Is that true?
Right. So yeah, one step at a time. You'll notice I have a lot of bars on the table, and most investors, when they get into this, even seasoned precious metal investors, they tend to gravitate towards coins like the Royal Canadian Maple Leaf, the US Mint, gold and silver eagles. Very, very popular products. But again, when we're talking about premiums and the total spread over the lifetime of the investment, like what does it cost me to buy it? What am I going to get to sell it? Again, bars tend to be more cost effective. So like if you took, for example, a 1 ounce gold bar and a 1 ounce gold coin, they contain exactly the same amount of metal, and they're produced by the same refineries. Like the Royal Canadian Mint in Ottawa, for example, produces these two, the Maple Leaf and actually this 1 ounce gold bar. So same producer, same amount of metal, but this gold bar on an ounce basis will cost you about $25, $30 less, 1%, 1.5% less than the gold Maple Leaf. So again, bars being more cost-effective option than coins. So if you're not really worried about what it looks like, you're going to save a few bucks by buying the bars.
Okay, very interesting. And finally, the third rule you have is larger bars have lower premiums and total spreads than smaller bars. So again, kind of sounding to me like bigger might provide better value, but I'm sure that people might want to own, different denominations. So I wondered if you could give us a sense of how you can achieve the right size mix.
Yeah, it's a good question. It's kind of the Costco effect, basically. When you buy in bulk, when you buy in larger volume, in this case, larger formats, you are going to save premium. So really good example. 1 ounce silver eagles right now. It's the most commonly bought coin, I think, silver coin in the world. Americans love their silver eagles. The premium on these, it's the highest I've ever seen in my entire career. Right now is about 60 or 70% above the spot price, which is so insane that I would never recommend anyone to spend their money right now on silver eagles. But my point is, if you were buying 100 ounces of silver today, so it's about $2,000 US, $2,100 US, you could buy 100 of these and pay, your 60 to 70% premium, or you could buy one 100 ounce bar and pay about 10% premium, maybe 8% premium. So you're like literally saving 50% on your investment on that single ounce of precious metals. It's a massive, massive savings for investors. So they need to be aware, especially in a market like this is very, very hot, that larger, or you said bigger, is better. And you can even go all the way up to these larger format bars like this 1,000 ounce silver bar, these 400 ounce gold bars. And if you're not in that size of market, there's all kinds of formats, kilos, 10 ounce bars. So there's a variety basically for whatever price point or investment point that you're entering.
Okay, I think this is all really helpful information for investors. It's great to have the visual. And so you mentioned the market is hot right now. We're speaking at a time when the gold price is up or around $1,770 per ounce the last time I checked. I wonder if you get more calls from people when gold is on the rise, or do you have people coming to you when the price is lower and there might be bargains?
And unfortunately, we've touched on this before, Charlotte. Unfortunately, here in our Western culture, a lot of people tend to sell on the way down and buy on the way up. And we did see a lot of that, kind of before this rally that we're talking about right now started. A lot of people kind of gave up on silver. It was trading at $17, $18. and they're like, I'm out, I'm timed out. I've just, spent too much time waiting for silver. What they really should have been thinking about is adding to their stock to their investment portfolio at a lower price point. And now, only just a few weeks later, the price is, being up $4 or $5 per ounce, which is pretty significant. So unfortunately, people do tend to buy kind of at the wrong time and sell at the wrong time. They need to work on that trend a little bit.
Yeah, we have talked about that before, and I bring it up again, hopefully to remind people and help them break that habit. Speaking about buying, so since we last spoke, we had a report from the World Gold Council come out talking about record central bank gold buying in the third quarter. And I think that echoed some trends that you spoke to us and that you just mentioned again here about how demand is there for gold, but it's coming from the East, not necessarily as much from the West. So I wondered if you had any thoughts that you would add now that we have this central bank angle also in the mix there.
Yeah, it's interesting. I was doing a little bit of research before the call today to see where, in fact, that gold was flowing to, which central banks were purchasing. So number one this year has been Turkey. They've added about 31 tons of gold. Pakistan is added about 20 tons, I believe. Qatar is number 4, India number 3. So they've all been very heavy buyers of gold. I know for Turkey, it's an inflation issue. They're fighting 60% plus inflation in Turkey. And I assume for the other countries, the general trend here is that they're trying to strengthen their reserves. They're trying to strengthen their cash reserves, basically their currencies. So that seems to be the trend. We're not seeing, Canada has not added a single ounce. I saw some articles again this week kind of calling out the Canadian government. Why are we one of the only central banks in the world that is not only not adding gold, we don't hold any gold? It's just in a period of time where Canada is fighting inflation, where our dollar has been sagging, we seem to be the odd ones out. But the point of the story is, central banks are buying aggressively, and I think they're just trying to strengthen their dollars and also their global strategic strength. I mean, this is a time where there's a lot of moving parts in the world with the war in Europe, and change of guard is kind of part of the discussion. The next superpowers, are they emerging from the East versus the West? And where do all these countries fall in that conversation? So really, really interesting to follow that trend.
Yeah, and I like that you highlight what's going on in Canada. I would certainly love to see them start adding some gold there. So we've been talking a lot about gold, but as you mentioned, there's other metals out there. There's silver, there's platinum group metals. I think you told us in a previous interview, when you're building your portfolio, you want to look at 60% gold, 30% silver, 10% for the PGMs. So are there any special considerations that we should be aware of when we're looking at silver and the platinum group metals?
Yeah, very good question. Two things come to mind. Silver, number one, a lot of people ask this, why should I own silver, or is silver a good buy? And they need to know the general trend. Silver will follow gold. If you look at an overall long-term trend line, they tend to kind of follow each other, but you'll see periods of time where silver really breaks out either to the upside or the downside. It's more volatile, both in a good way and in a bad way. So in a bad market, silver's down more than gold, and in a good market like we've seen recently, silver is outperforming gold. So that's why you want to have a component. We always say gold is the cornerstone of every precious metals portfolio. Silver is the trade. That's the one you have, that 20, 30%, maybe less, it's just a guideline, but that's the trade. And in a good market, you're going to benefit from that, and you're going to want to sell it at a profit. Don't forget that. A lot of silver bugs tend to hold on to their silver. They don't sell when they make money. Something else to keep in mind,